And without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled Unconventional Monetary Policy. I also ask unanimous consent that any member of the full committee that doesn't sit on this particular subcommittee be able to participate and ask questions during today's hearing. Without objection, so moved. I now will recognize myself for probably the better part of that 5 minutes. So lacking logic or evidence, today's macroeconomic oracles endorse unsustainable deficits and unconventional monetary policies. The oracles say the economy would be booming except for fiscal austerity. However, as the debt clock in this hearing room clearly shows, that it is often up, not unfortunately right now, but as it often is displaying, fiscal policy is anything but austere. Denying that their prescriptions created a heavy drag on our economy, the oracles point to ever-changing headwinds. For example, they tell us that an aging population is causing labor force participation to plumb bottoms last seen in the 1970s. Their hypothesis is short on facts, however. For example, median age in the 1970s is a decade lower than today's. So if aging is problematic, then the oracles would predict strong labor participation in the 1970s, even though it is the same disappointing level as today. The 1970s is also similar to the 2010s on another important dimension. Separated by 4 decades, they both suffered from distortionary economic and monetary policies. Refusing to let facts get in the way of fantasy, the oracles tell us that the American households would even be worse off except for these unsustainable deficits and unconventional monetary policies. The evidence? Well, we're doing better than the likes of Japan or the European Union. That story might fly in the faculty lounge, but it certainly doesn't around the dinner table. The star pupil in the class of central banks gone wild has nothing to brag about. The American dream is at a risk. Pre-recession productivity meant that living standards could double every generation. Under today's opaque and distortionary monetary policies, however, productivity has been cut in half. The oracles call this the new normal. Well, I believe they're wrong. This is neither normal nor acceptable. Not too long ago, our children could reliably look forward to the doubling of their living standards. Under today's monetary and economic policies, a doubling of living standard might instead wait for our children's children. With logic and evidence having left their side, perhaps the oracle should embrace a strategy from Seinfeld's George Costanza. Now, Mr. Chairman, I'm not sure we've ever quoted George Costanza in this committee, but here we go. If every instinct you have is wrong, then the opposite would have to be right. The oracles tell us that without their seat-of-the-pants response to the Great Recession, our economy would be even further below potential almost 8 years post-recession. The opposite would have had a hard time doing worse. Today's macroeconomics aim policies at highly aggregated variables that have little, if anything, to do with what drives our economy. Their answer for economic fluctuations is to further distort spending on consumption, investment, or government. But just as businesses cannot hide mismanagement for long behind the income statement manipulations, governments cannot mask malaise by diverting money into politically favored national income accounts. This pretense of knowledge has grown from a macroeconomic orthodoxy where repeated failures of unconventional monetary and economic policies count as evidence that we didn't do enough. Economic opportunity reliably increases when monetary policy adheres to its vital duty, that is, facilitating commerce, wherever it shows promise. Throughout our current economic malaise, monetary policy has not only ignored this duty, it continues to ignore the consequences of ignoring this duty. Annually since 2007, the Fed's Monetary Policy Committee predicted that its principle-free decisions would trigger a more resilient economy. Each year, reality fell further from prediction. And according to the Fed's own researchers, the FOMC, quote, did not anticipate the Great Recession, underestimated the severity of the downturn, and consistently overpredicted the speed of the recovery. A decade of economics-free monetary policy is not working because it cannot work. Returning to a robust economy requires a more firmly grounded and transparent policy. That transition cannot happen until the Fed shrinks its balance sheet, brings interest rate and credit risks out of the bureaucratic shadows. In the same vein, policy distortions will remain elevated until the Fed also returns to a monetary policy that does not only what it can, produce an efficient exchange medium so that goods and services, which includes labor, can easily find their most promising opportunities. The chair now recognizes the ranking member of the subcommittee, the gentlelady from Wisconsin, Ms. Moore, for 5 minutes as well for an opening statement.
Well, thank you so much, Mr. Chairman, and let me thank this distinguished panel for yet an opportunity to talk about our economy, our monetary policy, and to really sort of dig down deep into the theoretical and what will really work in the real world and the practical application. I want to make a couple of observations about this, what is it, Mr. Chairman, our fourth or fifth hearing on unconventional monetary policy. Which one? I yield. It's our fourth or fifth. Anyway.
Well, pretty much any time we've been discussing monetary policy, it's been about.
Right. And we have had a great discussion, particularly Dr. Taylor, on your Taylor rule. So we have examined this in the abstract, I must admit. And speaking of dinner table conversations, it's a great dinner table conversation. It's great economic journalism, but how would it have really worked in the real world? And we're having this conversation, of course, Mr. Chairman, and witnesses, because we have faced an unprecedented financial crisis. So the Fed has done its job, and they've been forced into unconventional solutions. We know from past conversations that had we had a Taylor rule, the Fed, with its responsibility, would have had to have deviated from it at exactly because of this kind of economic crisis. And I believe, Dr. Taylor, you'll get a chance to talk to us more in your testimony, but you yourself indicated to us that it was merely a guidepost. It was not something that was locked down. So it's not like we've had wild, unruly monetary policy pre-crisis. I commend Dr. Taylor's work, recognize his utility in intellectual circles, but I don't see, Mr. Chairman, any reason for this committee to endorse the idea for real-world application. Secondly, this hearing is an admission by the majority that the real problem all these years has been Republicans' refusal to seek demand-side fiscal solutions to help the economy. 70% of our economy is actually based on consumers having money in their pockets and being able to support a fledgling economy. The austerity measures supported by our Republican friends hurt the economy, hurt people, and forced the Fed's hand on monetary policy. Now, Republicans want us to buy the fact that tax cuts for the rich are the cure for this disease. Shareholders, the rich, have been the ones helped by monetary policy by way of stock prices. Now, Mr. Chairman, if you want us to unwind the unconventional monetary policy, we need to look at ways to help the poor in the middle class. Things like strengthening the safety net, like helping mothers, like investing in public education. How about public infrastructure? These are the kinds of things that stimulate the economy. The very things you will find in my bill called the Rise Out of Poverty Act. Helping everyday Americans still hurting in the housing downturn by robo-foreclosures by men like our proposed Treasury Secretary, who has helped himself by this government in crisis. Thank you, and I would yield back the balance of my time.
Gentlelady yields back. Well, today we welcome the testimony of four distinguished folks. Dr. John Taylor, Professor of Economics at Stanford University. Dr. Charles Plosser, Visiting Fellow at the Hoover Institution, Stanford University, and former President and CEO of the Federal Reserve Bank of Philadelphia from 2006 to 2015. Dr. Mickey Levy, Managing Director and Chief Economist, Berenberg Capital, and Dr. Simon Johnson, who's the Ronald A. Kurtz Professor of Entrepreneurship, Professor of Global Economics and Management, the Sloan School of Management at MIT. So each of you will be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, each of your written statements will be made part of the record. With that, Dr. Taylor, you are now recognized for 5 minutes.
Thank you, Mr. Chairman, Ranking Member Moore, other members of the committee, Chairman Henseling, for inviting me here to speak about unconventional monetary policy. I think the Federal Reserve's move toward unconventional monetary policy can be traced back a dozen years to the so-called too low for too long period of 2003-2005. During this period, the Fed held its policy rate, the federal funds rate, well below what was indicated by the experiences of the previous 2 decades of good economic performance. During this 2003-2005 period, the Fed also started giving forward guidance that its policy rate would remain very low for a considerable period and that it would be raised only at a measured pace. These actions were a departure from the policy strategy that had worked well in the 80s and 90s. Regardless of the reasons, the results were not good. The excessively low rates, along with promises that they would remain low, brought on a risk-taking search for yield and excesses in the housing market. Along with a breakdown in the regulatory process, these policies were a key factor in the financial crisis and the Great Recession. During the panic in the fall of 2008, the Fed did a good job in its lender of last resort capacity by providing liquidity to the financial markets and by cutting its policy interest rate. But then Fed policy moved sharply in an unconventional direction. The Fed purchased large amounts of U.S. Treasury and mortgage-backed securities in 2009, financed by equally large increases in reserve balances, which enlarged the Fed's balance sheet. And long after the recession ended, these large-scale asset purchases continued, and the Fed held its policy interest rate near zero when indicators used in the 80s and 90s suggested higher rates were in order. The Fed also utilized forward guidance in this period, but changed the methodology several times, which increased uncertainty. My research and that of others over the years shows that these policies were not effective and may have been counterproductive. There's now a growing consensus that the extra low interest rates and unconventional monetary policy have reached diminishing or even negative returns. The unconventional policies have also raised public policy concerns that the Fed is being transformed into a multi-purpose institution, intervening in particular markets and allocating credit, areas where Congress may have a role, but not a limited-purpose independent agency of government. In many ways, this recent period can be characterized as a deviation from more rule-like, systematic, predictable, strategic, and limited monetary policy that worked well in the 80s and 90s. The policy implication of this experience is clear. Monetary policy should be normalized. The Fed should transition to a sound, rule-based monetary policy like the one that worked in the past, while recognizing, of course, that the economy and markets have evolved. As part of the normalization process, the size of the Fed's balance sheet should be gradually reduced. For reasons I gave when I testified at this committee last May, reserve balances should be reduced to the size where the interest rate is market-determined rather than administered by the Fed as it sets the rate on excess reserves. Normalization is easier if there's an understanding of the basic monetary strategy. This and recent experience point to the need for monetary reform. A good reform is now part of the Reform Act. It would require the Fed to describe the strategy or rule of the Federal Open Market Committee for the systematic quantitative adjustment of its policy instruments. I think monetary normalization and reform have important implications for the international monetary system as well. Unconventional monetary policies with near zero policy rates have spread internationally to other central banks. Because a key foundation of a transparent, rules-based international monetary system is a rules-based policy in each country, normalization and reform by the Fed is a key part of international monetary reform. And I think international monetary reform will in turn benefit the United States. In conclusion, let me emphasize that monetary reform, tax reform, regulatory reform, and budget reform often go together. They reinforce each other. All are crucial to a prosperous economy. I think the opportunity for monetary reform is now better than it has been in years. Thank you, Mr. Chairman.
Thank you. And with that, Dr. Charles Plosser, you have 5 minutes for your presentation. If you could hit your red, there we go.
Thank you, Chair Huizinga and members of the subcommittee. I appreciate this opportunity to come share with you some thoughts on the Federal Reserve. Let me begin with 2 important points that illustrate the challenges as we think about central bank reforms. Central banks, for the most part, are given the responsibility to preserve the purchasing power of a nation's fiat currency. One way the Fed does this is by buying and selling securities in the open market to control the growth of credit and money. This gives the Fed extraordinary powers to intervene in financial markets, not only through the quantity of its purchases, but also the types of assets it can buy. The second point is that history teaches us that economic stability and prosperity are far more likely when there's a healthy degree of separation between government officials who are responsible for tax and spending policy and those in charge of printing money. Otherwise, printing money simply becomes an easy substitute for tough fiscal choices. Argentina is an example that has been stagnant and rife with periods of inflation and financial turmoil over the last 3 decades at least. In large part, this is due to a lack of effective separation between the central bank and the fiscal authorities. These 2 points highlight a major tension in the discussions of central bank reform. How, in a democratic society, do you preserve a central bank's independence while ensuring that it has the adequate tools for success and can be held accountable to the public? I believe there are 3 responsible ways to address this tension: simplify the goals, constrain the tools, and make decisions more systematic and predictable. All 3 steps can lead to clearer communications and a better understanding of monetary policy on the part of the public without undermining independence. In my brief time, let me just touch on 2 of these strategies. The Fed is said to have a dual mandate: price stability and maximum employment. Yet the broader the mandate, the more opportunity there is for discretion, and the more discretion means there's more scope for political interference and uncertainty over the direction of policy. Policymakers can find themselves futilely chasing one goal after another. Unfortunately, over the last decade, the Fed's mandate seems to have experienced mission creep, expanding the scope for discretionary action and the opportunity for political interference. The public and the Fed have talked as if monetary policy should be responsible for stock market valuations, income inequality, labor force participation rates, real wage growth, and an expanding list of other dubious objectives. Indeed, around the world, it seems that central banks are being asked to solve all manner of economic ills, from fiscal crises in Europe to low productivity and structural challenges in Japan and the United States. I think this is a mistake and potentially dangerous for the institution and the economy. Moreover, these broad mandates make it extremely difficult to hold a central bank accountable. I'm reminded of the old saying, responsible for everything but accountable for nothing. Institutions are guaranteed to fail when they are assigned responsibility for outcomes that they cannot substantially influence. The hubris of central bankers and the unrealistic expectations of the public and governments are out of line with what we can realistically expect from monetary policy. As the Nobel laureate Milton Friedman warned us almost 50 years ago, and I quote, "We are in danger of assigning to monetary policy a larger role than it can perform, in danger of asking it to accomplish tasks it cannot achieve, and as a result, in danger of preventing it from making the contribution that it's capable of making." One way to address these concerns and to help reset expectations is to narrow the monetary policy mandate to focus solely, or at least predominantly, on price stability. Many major central banks around the world already have such a more narrow mandate or a hierarchical mandate of this kind. It would focus the Fed's attention, reduce the opportunity for discretion, and make it easier to hold the Fed accountable for its actions. It would also provide some protection to the Fed from demands arising inside and outside central banks to pursue other, mostly unachievable objectives. A second way to restrict central bank interventions is to limit the types of assets that can be purchased, thus constraining the composition of the Fed's balance sheet. For the U.S., I suggest that the Fed be restricted to an all-treasuries portfolio. During the crisis and recession, the Fed engaged in large-scale purchases of mortgage-backed securities in an effort to help the housing sector. It also purchased distressed securities during the rescue of Bear Stearns and AIG. Such actions are a form of credit allocation and thus a type of fiscal policy. Fed independence should not include making fiscal policy decisions, as it undermines the separation of authorities and thus independence. Fiscal authorities should take responsibility for fiscal actions. If the Fed is to engage in the purpose of private sector securities or credit allocation, it should do so at the request of the fiscal authorities. The Treasury should then take possession of those assets in exchange for Treasury securities so the central bank can resume its task of conducting monetary policy, and maintain the separation of fiscal and monetary policy remains intact. Thank you very much for your attention.
Thank you, Dr. Plosser, and I have a sneaking suspicion that your Milton Friedman quote just beat my George Costanza quote. So, with that, Dr. Levy, we'd like to welcome you here as well, and you have 5 minutes for your presentation.
Mr. Chairman and members of the committee, I really appreciate this opportunity not just to speak about monetary policy, but also economic policies in general. The Fed's unconventional policies do deserve credit for lifting the economy and financial markets from crisis in 2008 and 2009. However, it's quite striking that since then, Fed's sustained negative real interest rates, quantitative easing, and forward guidance, while they successfully stimulated financial markets, pushed bond yields lower, pushed up asset prices, encouraged risk-taking, they failed to stimulate the economy. Nominal GDP growth, that is current dollar spending in the economy, is actually decelerated. The real economy's languished. In recent years, the Fed's unconventional policies have not had their intended impact, but instead have created mounting distortions and have been inconsistent with the Fed's long-run objectives and its objective of macroprudential risk. Why have the Fed's policies been ineffective? Because the constraints on growth are non-monetary in nature. Along with many factors, government policies have been a key source of the weakness. The adverse impacts are particularly apparent in business investment. Consumption and housing have been growing fine, but business investment has been notably weak, and this has not only been the weak link in the economy, it has been the source of the weak productivity and estimates of lower potential growth. Beyond the mounting government debt and expectations of higher taxes, there's been just this growing web of government regulations, mandated expenses, and higher tax burdens, not just on the federal level, but on the state and local levels, that have weighed very heavily, not just on the banking and financial sectors, but also in business investment in the broader economic environment. The burdensome micro-regulations imposed by Dodd-Frank have deterred bank lending, particularly of medium and small-sized banks, and they're at cross-currents with the Fed's easy monetary policy. In non-financial sectors, an array of regulations and government-mandated expenses and taxes have reduced efficiencies of production, inhibited labor mobility, and lowered risk-adjusted after-tax rates of return on investment. And they've added a tremendous layer of uncertainty in business decision-making. So while the Fed has very effectively lowered the real cost of capital, these government policies have forced businesses to raise their hurdle rates required for capital spending and expansions. So potentially productive expansion plans have been sidelined. Businesses are taking advantage of the low interest rates environment provided by the Fed to issue bonds, but they're buying back stock rather than expanding. Corporate indebtedness rises, and it doesn't add to productive capacity. And also there are a lot of distortions in labor markets. The critical point here is these policies are beyond the Fed's monetary policy scope, and trying to offset these negative impacts with excessive monetary ease has generated mounting financial distortions. And unfortunately, I think just now we're just beginning to feel the negative effects of the Fed having been too easy too long. The next couple of years may be kind of tough. So the Fed has recently come to acknowledge that its monetary policies have lost their punch and has recommended a shift toward fiscal stimulus. So before I outline some suggestions for monetary policy, I have a critical point to make on fiscal policy. It is critically important to distinguish between fiscal reform and fiscal stimulus that simply involves more deficit spending. The economy is in its 8th consecutive year of expansion. The unemployment rate's 4.6%, and the economy is growing at a pace consistent with the Fed's potential. What is not needed is counter-cyclical fiscal stimulus in the form of more deficit spending. The focus of fiscal reform should be tax and spending reforms that raise potential growth. Corporate tax reform, which involves lower rates and a broader base through reducing deductions, deferrals, credits, exemptions. And lower rates and simplification. This would encourage business investment and expansion. Infrastructure spending initiatives, they have to focus on projects that add to productive capacity and provide benefits that exceed costs while avoiding quick spend projects aimed at temporarily boosting growth and jobs. I mean, this is critically important. Fiscal reform does not just mean more deficit spending. And that's going to be critically important as we enter 2017. Now, on monetary policy,
And Dr. Levy, I'm going to have to ask you to wrap it up quickly here.
Quickly. Raise rates, cease reinvesting maturing assets, de-emphasize the short run and fine-tuning, change policy statements accordingly, and move toward more rules-based policies that provide flexibility.
And I will use some of my time to allow you to expand on that when we come back to questioning. So with that, Dr. Johnson, you have 5 minutes.
Thank you, Mr. Chairman. I agree with you completely, Mr. Chairman, with regard to your initial statement on the fact that this is not normal, what we have now, and it's not acceptable. I think you and I may have a slightly different reading of recent economic history, but maybe it's not that different. We had an enormous financial crisis and collapse. I was the chief economist at the International Monetary Fund in 2007 through August 2008. We were worried about how bad it was getting in the United States, and we encouraged preventive measures. None of that was effective, and the crisis turned out to be much bigger than what we'd anticipated, and much bigger than what we'd seen and what I'd worked on over the past 30 years. Now, I agree with Chairman Henseling that an undercapitalized financial system was the core of what went wrong. I think we disagree on some of the ancillary related measures, but lack of capital in our financial system, and funding it with way too much short-term debt was the core problem. Massive financial crises result in anemic recoveries. I'm afraid that's not a statement about the United States. That's a general statement about what we've learned over the past 200 years of finance and economics. The second point on which actually I think, I certainly agree with most of my fellow panelists, is that monetary policy is a limited tool that cannot do very much. And I think and I agree with Dr. Plosser, you shouldn't overreach with monetary policy. I would say, and I think I see that in some of the other testimony, including Dr. Levy's, that QE1, done at the end of 2008, 2009, absolutely unconventional monetary policy, yes, specifically targeted at supporting mortgage-backed securities and a piece of the key pipeline for credit and securities markets that are broken completely. That's what they did. I think it was a good idea. The fog of war applies in finance as well as in war. You don't know exactly what's happening at the time, but I fully support what the Fed did in that instance. Subsequent iterations and attempts to continue with that policy, we can discuss. I think much less effective would be a fair way to say it, and that's also what Mr. Bernanke says. Rules can help monetary policy, and if hypothetically, Dr. Taylor or Dr. Plosser end up back on the FOMC, I will be fully supporting their right and ability as members of that committee to determine rules. I really don't think you want to micromanage the Federal Reserve, but it's not what we've done historically. You can set the objectives, and I commend you, Mr. Chairman, for focusing our attention on that. I think that you should continue with the existing objectives, personally, but I think we're going to discuss that a lot more. The third part of what went wrong in the economic history is a piece I'm sure we actually disagree on completely, which is fiscal policy. Again, former chief economist of the IMF, I don't run around the world telling people to stimulate their economies, and I'm not in favor, generally speaking, of using fiscal policy for any short-term response to anything. Right? That's more the job of monetary policy if subject to Taylor rule type considerations. However, again, largest financial crisis since the Great Depression, limited ability of monetary policy to respond, QE1, but perhaps we're not convinced of anything beyond that. What else do we have? We have a massive crisis. You said, actually, I liked your formulation of monetary policy. It was one of my favorites ever. I wrote it down. Monetary policy should be to facilitate commerce. Absolutely. Completely correct. The private sector economy was broken. And 99% of people in the private sector economy had no responsibility for what went wrong. They were completely innocent bystanders. And that includes a lot of people in finance, by the way. They were just doing their jobs. Devastating impact, limited ability of the government to respond with monetary policy. What else are you going to do? In those circumstances, and only in those circumstances, I think, and I testified before other committees of Congress to this effect at the time, that some fiscal stimulus, including large tax cuts, I argued for bigger tax cuts than were actually put through by this Congress, by the way, as well as other measures on the spending side. We're out of that phase. Now the issue for fiscal policy is medium term. How do we get away from this normal, quote-unquote normal, how do we get to higher rates of growth? And here I'm completely siding with Congresswoman Moore. I work a lot with the private sector. My job at MIT is to help companies grow in the United States and around the world. What do they need? They need people. They need human capital. They need infrastructure. I'm not saying that this is the miracle cure. I'm not saying you do it on a 1 or 2 year time horizon, but I think over a 10 to 20 year period, when you look at productivity prospects in the United States, when you look at our ability to compete, when you look at the ability of our companies to stand up and to do better than other companies with regard to innovation and employment, people, really good people. And of course, that's about opportunity, and it's about who gets the education and who can climb up the social ladder, which we used to be good at in this country, but unfortunately, in the past 3 decades, we've lost that. Thank you.
I appreciate that. Thank you very much. At this point, I will recognize myself for 5 minutes. And I'd like to go back to Dr. Levy, because I think we stumbled into something, and we did this at another hearing previously with the ranking member and myself, that we agree that, frankly, the rich on Wall Street have gotten richer, while most others have been left behind. And kind of getting to where Dr. Johnson was going, the question is why and how? And is this because we have not borrowed enough money to do more stimulus spending, as some would seem to argue, or, and Dr. Levy, when you were talking about this, I had written this out on my notepad of a recent example. I sat down with a CEO of a publicly traded company, large, influential, sort of in the financial services space, and he walked me through the pressures that he is feeling from his shareholders, including institutional investors like CalPERS and others, to take advantage of the artificially low interest rate environment, to borrow money, to then buy back his own stock, and as he said, or the stock of the publicly traded company, as he said, I have become fabulously wealthy. In fact, I looked it up. He had just cashed in a 7-figure amount of stock. Again, he said, I've become fabulously wealthy, but it is not the right thing for the economy overall. And it was in stark terms. And he's like, but if I don't do this, so I've got one small little corner of this, but I've got CalPERS and I've got a number of other institutional investors who literally could take me to court for not fulfilling my requirement of maximizing the return for them. And that was rather stark for me, and just wanted you to maybe comment on that a little bit. And I'd love to hear from all four of you quickly. My original question, has the Fed become more political? And I kind of maybe altered this, changing it slightly. Has the Fed been politicized is really what I want to know. And so, Dr. Levy, I want to start with you and give you a brief opportunity as well to touch on if you had any of those other points that you wanted to make towards the end when I had to cut you off. So,
Has the Fed become politicized? Yes, on the inside, the way it operates, and on pressures from the outside. And I think it's a real concern because we all benefit from a central bank that pursues its long-run objectives. And so there's a laundry list of ways that the Fed's become much more politicized. But back to your point on Wall Street, and I'm an economist and not an investment banker that is benefited by all the Wall Street largesse. Wall Street makes a lot of money through leverage, okay? And so, when they've had low capital positions and a lot of leverage, and they've played the positive carry game and taking advantage of their leverage, this generates very large profits. So I would be very much in favor of legislation that requires higher capital adequacy, while at the same time reducing a lot of the micromanagement from the Fed, the OCC, and the like. And so I think this would that would lead to better balance of people on Wall Street.
and isn't it true that, I mean, companies, whether in the financial services space or whether they're frankly in manufacturing or any other space, they're not just looking at tax rates, they're looking at the regulatory environment that is causing uncertainty, correct? I mean, when they're going in, I think that's why we've seen, at least some would argue that we've seen some rebounds in the overall optimism, is that there's going to be some stability, hopefully, and some predictability in the regulatory space, not just in that tax space.
I completely agree. When surveys of businesses, business's biggest concern, of course, is product demand, but right behind that are concerns about taxes and regulation. So once again, while the Fed has been very successful lowering the real cost of capital, businesses, when they think about expanding and investing, their hurdle rate is pushed up by taxes and by regulations, not just on the federal level, but the state and local levels where they operate. And it adds a huge layer of uncertainty, and they have to put that in their calculation. And so unwinding that, the buildup in regulations, I think would really lift a gray cloud off of business investment and expansion and employment. And I think what I think the other panelists would totally agree with me on is if you could put in place policies that would lift productivity and potential growth, that would lift real wages.
All right, and unfortunately, my time has expired. I wanted to get to a comment from Jeffrey Lacker about markets being better judges of creditworthiness than central authorities, but maybe we'll have a round two, or one of my colleagues can pick that up on that as well. So with that, I would like to recognize the ranking member for 5 minutes.
Thank you so much, gentlemen. And of course, it's a pleasure to have you all here. Just want to start with, I think, Dr. Levy. This was a very sound testimony from you, and I got really, really interested in your comments on page 1, 2, 3, 4, where you talked about household behavior. And dimmed expectations of disposable income, and so on. People, households spending more money on health care, tight mortgage credit standards. And so I guess where I'm leading to this is some comment or observation on your part about the lack of income, the policies, the austerity policies, that were put in place here, while simultaneously experiencing this downturn. Do you see that there's any nexus between the tightening, because you say here monetary policy can only do so much. So do you see any nexus between the lack of income that people have and the inability for our economy to grow?
So real or inflation-adjusted disposable income's been growing at a moderate pace, and the data show that people are basically spending it. So consumption's growing once again at a moderate but not a robust pace. And at the same time, some government regulations and government mandated expenses, particularly in healthcare, have forced households to allocate more of their out-of-pocket spending toward healthcare, insurance premiums, and the like.
So just to be clear, you don't necessarily see $7.50 an hour as a minimum wage as contributing to the slow growth. You see it all being caused by, of course, the downturn in the market, the lack of regulation. I think somebody testified to the lack of regulation being one of the causes. So you don't see the lack of income on people's part as contributing to this?
My honest assessment is the biggest factor that's inhibiting stronger wage growth is productivity. And I think
People are more productive than they've been. Maybe, Dr. Johnson, maybe you can help me out here.
So I think the way where you're going with this, Congresswoman Moore, is absolutely correct, that the impact of fiscal policy and austerity has been disproportionately at the lower end of the income scale. Obviously, income inequality has been an issue with us for a long time. And the big question we have, and also to the point Chairman raised, is if productivity increases, that's good. It creates potential for wages to rise. But wages at the lower end, incomes at the lower end of the income scale have not risen very much over the past 3 decades, actually. So there's a bigger problem there, and I think that's one reason why raising the minimum wage to an appropriate degree would be part of a response that would make some sense.
And, lack of providing adequate monies for infrastructure, educational funding, and so on. Dr. Taylor, I just want to, since you are a distinguished guest here, I do want to give you a chance to answer a couple of questions. You think QE1 was okay, right? But not the other monetary policy. Did I hear your testimony correctly?
There's sometimes confusion about what QE1 means. To me, that was the purchases of securities in 2009. There was also a big intervention in 2008, and that's the the lender of last resort, firms in stress, liquidity operations, and those actually phased out very early 2009. It's really after that I think there was questions about the effect.
Okay, thank you. I just want to ask my last 25 seconds, back to you, Dr. Levy, fiscal reform versus fiscal stimulus. So is it your testimony, really, that fiscal stimulus would not be an effective tool? And this, of course, would be done in Congress, not as monetary policy.
I would love to see fiscal stimulus, but I think that involves more, not just increasing deficit spending that provides income support and gooses up jobs in the near term, but increased spending, reallocating spending in a way that helps out the economy and lifts productive capacity. And once again, if you look at the whole size of the government's budget, there's certainly enough ways to reallocate to spend a lot more on things like infrastructure, education, and training.
Thank you. Thank you, Mr. Chairman, for your indulgence. And I yield back.
You're very welcome. And with that, I'd like to recognize the Vice Chair of the committee, Mr. Mulvaney, for 5 minutes.
Thank you, Mr. Chairman. The last time that Janet Yellen was here, she and I had a chance to talk very briefly about another type of unconventional monetary policy that we haven't discussed yet today, and that is the purchase by central banks of actual equities. She had given a speech I asked her a couple questions, and I had a chance to follow up and ask her some questions, written questions for the record. And I want to read you, gentlemen, very quickly the 3 paragraphs from that letter, and also would like to add the record to the letter to the record.
Without objection.
This is her response. It says, in my remarks at this year's Economic Symposium in Jackson Hole, I noted the challenges for monetary policy posed by the effective lower bound on interest rates and the possibility that we may face these challenges more frequently in the future given the apparent decline in the so-called equilibrium real interest rate. To address such challenges, I noted that monetary policymakers may again need to rely upon unconventional tools such as forward guidance and asset purchases to promote statutory goals such as maximum employment and stable rates. On the subject of asset purchases, it is important to note that the Federal Reserve Act provides authority for the Federal Reserve to purchase only a relatively narrow range of low-risk assets such as Treasury and agency securities. The Federal Reserve does not have the statutory authority to purchase a broad range of private sector obligations such as corporate bonds, equities, asset-backed securities, or household debt. In contrast, other central banks, such as the European Central Bank, the Bank of England, the Bank of Japan, and the Swiss National Bank, have the authority to purchase a relatively wide range of financial assets. Moreover, these central banks have utilized their authority in recent years in different ways to address severe economic shocks. And she and I went on to talk about the fact that I think the Bank of Japan and I think the Swiss Bank had actually started buying equities. The Bank of Japan, I think, was buying ETFs. I can't remember what the Swiss were buying. So let's talk about this other unconventional type of monetary policy. We'll start with you, Dr. Taylor. Your thoughts on that generally? Have you given any specific consideration to this topic?
Well, I think the Fed should stay away from buying equity.
Why is that?
Simple as that. Because it's, first of all, it is a form of quantitative easing. And there's other things to do with respect to monetary policy. It can adjust its balance sheet to make the interest rate move in a desired way without touching equity. There's plenty of securities to buy. So I think it also goes in the direction of potentially helping certain firms and not others. It is a form of intervention which seems to me not broad-based or limited as monetary policy should be. You can choose one firm versus another. There's all sorts of things that can happen. So I think it's not necessary. So.
And in fairness to her, she went on to go through a list of advantages and disadvantages, so I couldn't read the whole letter. But when she comes back, if she were sitting here and you're having a conversation and she says, yeah, John, but we're out of bullets, we need something else, what would your response be?
I don't think you need anything else. I think we've had a lot of history. We even had ideas about what to do at the so-called zero bound, which doesn't require that. It's some indication of what's going to happen after the zero bound. There's been lots of work on that. There's plenty of other securities to buy to set monetary policy.
Dr. Plosser, Dr. Levy, I'd be curious to know your thoughts on this. I'm not going to get a chance to ask you questions, so I'm going to do it in writing because I enjoy my back and forth with Dr. Johnson so much because he's a really good participant in these hearings. So, Dr. Johnson, I'll give you the last minute and a half of my time. What are your thoughts on this particular unconventional monetary policy?
Well, I think I'm going to surprise you, Mr. Mulvaney. I think you're asking a very good question, and this is the right time to ask it in a time of peace, not when we're on it. And I agree with you. I don't think, I agree with Mr.
I yield back the balance. No, I'm sorry.
The chair will suspend the clock here because I'm not sure we've ever seen a compliment like that paid to the vice chair.
Yes,
so,
so I'm happy to make your day. So I think that in the United States, I would stick with the authority that the Fed has, and I think that's what I heard Dr. Taylor said. I can't imagine circumstances in the United States in which buying equities would be appropriate. Other central banks do different things because of different market structures. Sometimes they feel they don't have enough bonds and so on. I'm not going to comment on that. I don't think that, and I think, what Dr. Taylor said, you don't want the central bank to be directing credit. You don't want them to be playing favorites. You don't want to be, I think the Fed is politicized from the outside, as Dr. Levy said. I think they've actually retained an impressive degree of non-politicization on the inside. If they get into allocating credit more than they have, that would be a problem. So just on QE1, if I might, what they did was a specific purchase of mortgage-backed securities that were underwritten by or issued by Fannie Mae and Freddie Mac, which had been taken over by the government. So they have to buy government-backed securities, no credit risk. That included those housing securities at that moment. I think actually we're agreeing. So that's a slightly uncomfortable point which we should discuss also. But I think what you're hearing from all of us is, at that moment, not a bad call, given the fog of war that they face. But, I think you should push us on that.
Thank you to all the gentlemen. Dr. Plosser, Dr. Levy, again, my apologies for the limited time. I don't get a chance to ask you, but I do hope to have a chance to follow up in writing. Thank you. Thank you, Mr. Chairman.
Gentleman yields back. And with that, we will recognize Mr. Foster of Illinois for 5 minutes.
Thank you, Mr. Chairman, and thank you to our witnesses here. One of the most important inputs to monetary policy is inflation. And there is a strand of debate going on in economics right now about whether we are significantly mismeasuring inflation, in large part by underestimating the technological price reductions and quality improvements, or just the existence of products that were not previously available. Examples of this are medical care, for example. If you give the average person the choice of having today's medical care at today's prices versus 1970s medical care at 1970s prices, most people would choose today's medical care, which tells you mathematically that healthcare inflation has been negative, whereas in fact we carry it on our books at 6% a year, and that's 17% of the economy. So it's not a small error if this is true. There are other things. We carry in our pockets a supercomputer that has a value of tens of millions of dollars in 1970 dollars, and somehow we're not scoring it in the naive way. This drives the debate on a number of things. When you ask the question, is the median family better off than it was a generation ago? If you look at the basket of goods by the median family a generation ago versus today, I think most people would agree it's better off, despite the fact that if you look at, the wealth or income of the median family, it's not so good. So my questions are this. First, do you agree with this narrative that we're actually making a significant error in how we are measuring inflation? And secondly, what are the implications for monetary policy if, in fact, we're not measuring inflation properly? Let anyone who's up for fielding any part of that.
I think, Mr. Foster, it's a very good point, and a rather broad and subtle point, which affects both how we think about inflation and obviously purchasing power. And you're right that we have some parts of our consumption basket didn't exist or would have cost a fortune previously, and we don't take that into account very well. I think to the point about monetary policy, which is obviously the focus today, there's a heuristic that central banks have. There's nothing that says that inflation should actually be 2%. I mean, there's no law of economics or physics. That's the heuristic that's developed over a very long period of time, where the central banks feel that at that rate of inflation, you can facilitate commerce, you can have growth. It's consistent with high levels of productivity growth in the past. Now, that heuristic may change. I mean, I think this is why I like what John Taylor said in his testimony, which is the Taylor rule is not a hard and fast, this is the law. It is guidance, which Dr. Taylor spotted and helped us understand in terms of what the Fed did in the past. So a good reason not to micromanage the Fed going forward is we want to have very smart people there on the board of governors, and I'm confident that Congress will put smart people, and the President will put smart people in there in the next iteration, and they need to be thinking about all these issues, including this one, Mr. Foster, and think about, okay, how do we continue to operate monetary policy? Is it the 2% implicit inflation target with the dual mandate, which I think works and other people on the panel don't think it works. But that's a decision. Okay, so Congress sets the mandate. I think you want the Fed, Board of Governors, and the FOMC to have the ability to think deeply about these issues. A lot of very smart people there, a lot of engagement with the private sector, and think about, do we have the right way of managing monetary policy? Do we have the right implementation of monetary policy, given the kinds of concerns you're raising?
Yeah. Anyone else have? I mean, it was specifically, if we conclude that we're mismeasuring inflation by, say, 1%, what implication would that have for monetary policy? Just, I guess, from straight mathematics.
So first of all, our measures of inflation they're different. There's different measures, and it's a constant decision for central bank, the Fed, to decide which one. And so they've gone through it, and we have statistical agencies that worry about the problems you're saying. I'm not saying they do it effectively, but they try to take it into account. Given all that, it seems to me monetary policy should take the indicators that are there and stick with those. If there's a lot of evidence that there's something wrong because of the computer technology you're mentioning, then we need to know that. It's actually, to me, almost more important a problem for measuring productivity. I mean, I think productivity growth is very low now. It's distressing. That's why I think we need tax reform and regulatory reform. Some of my colleagues in Silicon Valley say, no, we're just fine. We're doing great on productivity. I don't think so, but that's really, I think, where the productivity issue really comes to be most important.
Also, the divergence of labor factor productivity and machine factor productivity is, I think, accelerating and will become very significant in our thinking in the coming decades. Any other comments on the inflation issue?
reiterate what both the other panelists said. For monetary policy purposes, yes, you need to be aware of the mismeasurement, but it's a heuristic. It's a way to commit to something. And it doesn't mean it's the optimal or the best rate of inflation. A lot of people would have argued inflation rate targets should have been lower. Some think they should have been higher. But it's a guide to policy, not so much as an objective way. I would also point out that if true inflation is really much lower than we think it is, then it means things that we do to calculate, for example, real wage growth over the last 30 years, which suggests that actually real wages are higher than we think they are because inflation's been lower than what we made.
Which would change the narrative we see in our politics tremendously.
Exactly. So, I think there are I think we need to distinguish that issue from the issue of what's useful for monetary policy purposes. And I think that's what John was getting at.
Yeah, so what you're saying is essentially it is, as long as you have a stable definition and you're using it as your feedback loop, either your input,
monetary
your feedback
policy
loop,
purpose, that's the critical.
that it's still a useful thing to make a stable feedback loop.
Right.
All right, well, I guess that was my main question.
Gentleman's time has expired. I thank the gentleman. Now recognize the gentleman from New Mexico, Mr. Pierce, for 5 minutes.
Thank you, Mr. Chairman. I appreciate each one of you being here today. John Taylor mentions in his paper, his presentation, that maybe the feds should start selling assets. So, Dr. Plosser, I think you might be the one who's closest to the process. What would happen if the Federal Reserve started selling mortgage-backed securities that they purchased back at a time when you were in the system?
Well, I think the committee and the Fed was terribly worried about the effect of selling securities into the open market. They certainly expressed concern about that. But I think that the first step the Fed ought to be taking is not selling necessarily. I think what they could stop reinvesting would be a good practice, because in effect they're still buying securities in the open, buying mortgage-backed security to replace the ones that run off just naturally. So I think they wouldn't have to start selling securities immediately. They could just stop reinvesting. I would also note that the process of selling securities, now that the financial crisis and the functioning of the markets is has returned to more normal activities, one of the concerns during the purchase of securities was that the markets weren't functioning very well. There were sort of lots of gaps. There were lots of concerns about where buyers and sellers were and sort of the trading of information and arriving at prices. That's no longer the problem anymore.
Have all of the valueless MBSs been choked out of the system?
Right. So I think, yeah.
The ones with no value are gone. They don't exist anymore.
Well, not many of them, no. But the Fed's still buying them. So I think there is less of a problem now to disrupt.
What happened to the ones with no value? That was at the basis of what caused the collapse.
Right.
Valueless loans that were made across the country,
the Fed was trying
securitized and put in. So what happened to them? They just vaporized?
Well, some of them restored some of their value. The Fed was busy trying to make a market.
So they have achieved some value.
So they've achieved.
Dr. Levy, I was interested in what your perception is on the answer to Mr. Mulvaney's question. I looked back several years ago, and the state of Ohio started buying assets. They got into buying coins, chasing yield, trying to find anything they could do. And so this idea of buying assets is one that's concerning. And then when you look at the CalPERS, I think the Chairman Huizinga mentioned them, all of the pensions are going to be chasing yield because they're promising payouts based on totally false assumptions that they can make 6 to 7% in the market, so they're paying out to the recipients. So I would like your observation on what Vice Chairman Mulvaney asked about the process of buying assets and stocks.
Well, let me just address your first point. Okay, so the Fed has, through its QE programs, increased excess reserves in the banking system up to about $2.5 trillion, and the Fed's balance sheet is nearly $4.5 trillion. And it's kept rates artificially low. And this has created distortions. And now, as I think the Fed begins to normalize, particularly I believe there's an economic regime shift underway and rates are going to rise, there's going to be pain. But during the period of low rates, it has forced insurance companies, pension funds, and the like to reach for yield, take on more risk than they would otherwise. And that there's the downside of that we're going to face now. Now, with regard to QE, should the Fed be buying stocks? Absolutely not. For what purpose? Do you want the stock market to go higher? And as Dr. Johnson said, do you want the FOMC members to deliberate on which companies to boost? It makes no sense. And all of the excess reserves and low rates have not stimulated aggregate demand in the economy the last 5 years. So for what purpose?
Isn't that the process they moved into in Japan, and isn't that one of the causes of trouble? Again, I'll just yield to you, Dr. Levy.
When we look at Japan, let's call a spade a spade. The central government runs a very large budget deficit, very large, and primarily to finance retiree pensions. And they don't want it to show up in their general as an increase in the outstanding debt, publicly held debt. And so they use the Bank of Japan, and they stuff, the BOJ through its QE buys more than 100% of the increase in the debt. And so the BOJ buys JGBs, and it buys corporate bonds, and it buys ETFs. It's all a financial shell game. And it's the poster boy for what we should avoid.
Which, again, gets toward my concern that some of what we're doing appears to be a shell game in a lot of ways. Yield back, Mr. Chairman.
Gentleman yields back. With that, the chair recognizes Mr. Heck of Washington for 5 minutes.
Thank you, Mr. Chair. I have a question for Dr. Johnson. Before I ask it, with all due respect, sir, I just thought I might point out that you referred to Congressman Foster as Mr. Foster. He, in fact, has a PhD in theoretical physics from, I grant you, it's only Harvard, sir, but he likes to remind people that he is the sole remaining actual scientist in the United States House of Representatives. Point of future reference is all, Dr.
It
Johnson.
says Mr. Foster on his name tag, so perhaps you can have that changed.
Point well taken. So, Dr. Johnson, I've been on this committee and in this body for almost 4 years now and have tried to be an unwavering advocate for increased spending on infrastructure to not just stimulate the economy, but to stimulate growth over a long period of time, lay the foundation for increased productivity. I've even gone so far as to encourage then Chairman Bernanke to consider using their tools to help with infrastructure spending by municipalities. He said they didn't have the authority. That despite the fact, by the way, that they actually did exactly that when Metro was built here several decades ago. I also suggested to him that that's what they were doing with QE in the housing market. He denied that. I take a different conclusion out of the net effect of that particular activity on the part of the Fed. But here's what I'm struck by. I tried to get Chairman Bernanke to do it. I've had this conversation with Chairperson Yellen. I've encouraged all of my colleagues to step up to an increased infrastructure spending bill. We did the FAST Act, which was very modest, frankly, very modest compared to what I think the need is. But that was when unemployment was 8%. And unemployment now is 4.6%. And an awful lot of the same people that resisted aggressively increased expenditures on infrastructure have now come around to be an advocate for it. And so my question to you, Dr. Johnson, is why would increased spending on infrastructure be a bad thing when the unemployment rate was 8%, but a good thing when it's 4.6%? I do not understand that.
Well, Congressman, I think the main case for infrastructure, which I include physical infrastructure, transportation, schools, and the human capital infrastructure, which is everything else around the way we train people, I think it's hugely important for productivity growth. So, in the parlance of the IMF, it's medium-term objectives that you should have for fiscal policy, and I think that's exactly what you've been saying. Now, there is an additional argument for fiscal policy if you think that monetary policy is limited in its effectiveness and the economy, the private commercial part of the economy, needs some additional help. And I think that was a good argument at 10% or 8% unemployment. That piece of the argument is, I think, weaker now, but the medium-term argument is incredibly strong. In fact, we're, I think, agreeing that there are big medium-term issues, and I would certainly get at them in this way. Now, if the question is alluding, as I think it may be, to what President-elect Trump has said about infrastructure and what appear to be the plans that are materializing, I'm not confident, Mr. Heck, that that actually is infrastructure spending of the kind that you're envisaging and that I just stated. I think it may be some different form of tax breaks of some kind, either for existing infrastructure projects or for some other projects that will end up being more expensive and will get less effectiveness out of them compared with doing it through Congress. I would emphasize, though, and I think we're all agreeing on this, that fiscal policy, infrastructure, is the responsibility of the fiscal authority, which is the Congress in the United States, acting through the executive branch. It is not the responsibility and should not become the responsibility of the Federal Reserve. I take your point about the metro. I don't know how they did that one, but that's not
What about my QE?
So what they did on QE, and this is back to the point.
Was it not in effect a stimulus of the housing market indirectly?
So, yes, Mr. Heck, it was. But this is back to our point of violent agreement among ourselves and with Mr. Mulvaney. QE1 was targeted at a specific breakdown in the mortgage-backed security market that was hugely important to housing, to house prices, and for reasons you all understand, the financial sector and the economy. So in that fog of war moment, it was a good call. And yes, it was specifically targeted. Remember,
okay,
the
but
Fed...
My point isn't that they should embark upon this journey, although I have made that point in the past. My point was, and I take from your remarks, it was a good idea to increase our investment in infrastructure at 8% unemployment. It's a good idea to do it at 4.6% if it's done the right way,
yes,
especially with an eye toward long-term growth and increased productivity where we can gauge it.
Absolutely.
Fair enough?
Yes.
I see I'm close to being out of time. I'm given to believe that we may have a second round, so maybe I'll have another chance to get in the auction here with you all. Thank you all for being here very much. With that, I yield back, Mr. Chair.
Gentleman yields back. With that, I will recognize Mr. Schweikert of Arizona for 5 minutes.
Thank you, Mr. Chairman. One of the problems is a lot of the really interesting questions have already been part of the exchange. Can we all have an agreement, though, that expansive monetary policy does enable those of us who are responsible for fiscal policy? It sort of indemnifies us from doing things that are hard, are controversial, are sometimes ideologically hard to explain. So, and I'm not even asking that one, I'm just sort of saying it. Can I walk through a handful of things? And there's one just because it's something Mulvaney and I have talked about, and I'm just curious. So this one, Dr. Johnson. If we were to talk about sort of non-conforming monetary policy that would be within the rules of the U.S. Federal Reserve, let's say we'll talk about like during the time of QE1. Could they have bought the loss piece of an MBS securitization instead of buying the entire securitization? It's just a quirky idea I've often wondered about. Would that have also been a way to change the bandwidth of the exposure for investors?
They're not allowed to take credit risk. And then they're only allowed specifically to buy government-guaranteed securities, which in normal times means treasuries, but after Fannie and Freddie were nationalized, that included the agency securities. So I think the answer would be, if you're talking about, picking and choosing within the Fannie and Freddie
it would be,
securities,
let's say a Fannie, a nationalized Fannie Freddie selling, as they've been selling the credit risk.
But what they did was much smarter than that, Congressman. What they did was they bought new issues. So that was the pipeline that had broken down, and they targeted the QE1 on enabling that process to restart. So, think of it like a kickstart or cranking the engine on, right? And that, I think, was a good use. And to do that, you would want to be buying the entire issue, not picking and choosing within the new issues.
Okay, so on one side, it would be an approach for what is collapsing. The other side would be keeping the channel healthy, or at least
ongoing or restarting it.
And this may be more for Dr. Is it Levy? Or Levy? If I came to you right now and said, what's our greatest exposure for a difficulty that could happen in our markets right now? If interest rates start to move upward, a simple example I can give you is just the other day I was looking at a number of non-publicly traded REITs that were paying some fairly healthy rates of return. But if you looked at the underlying asset, they were very interest and sensitive, tenant sensitive, those things. Are we heading towards a moment where the next economic difficulty we see is, as interest rates are moving away from us, that the cap rate compression that we've had now starts to move against them, and all of a sudden we once again have another great difficulty in parts of whether it be commercial real estate market, these non-publicly traded REIT markets. What's our next great exposure you see on the horizon?
Well, there's certainly a risk, because after keeping rates really too low for too long and pumping so much liquidity into financial markets and encouraging risk-taking, global portfolio managers base their investments on that framework. And now things are going to change, and there are going to be some losses along the way. Now, I would point out that the interest rates have increased rather significantly in the last couple months, particularly post-election. I would say that's healthy, because you actually want rising real interest rates reflecting
The reality.
healthier expectations for the future.
I guess my concern was just being, our brothers and sisters being sort of emotionally prepared that we do have a lot of misallocation of capital, yield chasing, and some of that is going to have some difficulties as the rates move.
And I'd say the answer to that is yes. You just cannot do what the Fed has done the last 7 years and expect there to be no eventual unwind. I think the offset to that is if in fact we do get economic reforms that raise, not just temporarily, but raise potential growth, then there's a very, very positive offset.
Les, and we won't have time for this, but I'm hoping when we get to a second round, we can start to have a discussion that's sort of one-off from sort of the monetary and those of us who are fixated that there's been a massive misallocation of capital not going to its most productive allocation. But what would you have us do from fiscal policy that would maximize productivity gain? Because I think that's something we all agree, there's something wrong out there for the last decade in our productivity numbers. And with that, I yield back, Mr. Chairman.
Gentleman yields back. With that, we'll recognize Mrs. Love of Utah for 5 minutes.
Thank you, Mr. Chairman, and thank you, the panel, for being here. This has been really just a great panel, and it's been given me quite a bit of insight. So, I guess I'm just going to explain what I've heard, and then get your comments on what you think, whether you think that this is, if I'm getting it correctly. So, one of the comments that was made by Dr. Levy, which I think is right on, is a clear explanation by the Fed of the monetary policies and the factors that have contributed to the lower potential growth, weak capital spending and productivity, and structural unemployment would help steer the economic policy debate towards the issues that really matter for performance. I think that hits the nail on the head. So if I look at where we were at the beginning, 1913, versus where we are today, where the Fed was involved in dollar stability, low inflation, bank oversight, to 2016, where it's inflation, full employment, expanded bank holding companies, oversight, FSOC, you name it, a whole host of responsibilities that have been put on the Fed's table, responsibilities. We talk about the CFPB, we talk about all of these other arms that really start to affect the economy and how everything is run. I start thinking about what's happening today, and the frustrations of the American people today is not really the responsibility or should be reflected towards the Federal Reserve. It should be towards Congress. If you think about when we think about what the panel is saying and the whole host of things that the Federal Reserve is dealing with right now, the fact that this body today is made up of mostly Republicans. Also, the Senate and the House and the White House is a reflection upon the frustration of that the American people have today. So I believe that it's not about what the Federal Reserve is doing, but it's about what the House of Representatives, what Congress is doing altogether. And that we have literally said we are not going to take the responsibilities of the economy, but we're going to put it on the table in the hands of the Federal Reserve. And I think that it's time for us to decide what the Federal Reserve is responsible for and what we're willing to take responsibility for. I'm going to give a short example, and then I want you to explain, to tell me if I've got it right. So if I look at my home and I have a child, for instance, that is sick, that has a fever, my job is to go into the cupboard, I grab Tylenol, and I decide what the best dosage is for the right age of that child and give that child the right dosage. And when I look at what the policies of Dodd-Frank and all of these other things, the responsibilities that the Fed have, I feel at this time right now, we've literally taken the entire bottle of Tylenol and given it to the child, where now we've got all sorts of problems that we're trying to adjust and we're trying to fix, and it's not working. So I just want to get your thoughts on that and tell me if we are on the right track and what we need to do as a body to make sure that we are taking back the reins of what happens, or responsibility to what happens to this economy. I did quote you, so Dr. Levy, I was wondering if you could comment on that.
All I can say is great comments, and I really appreciate that, because I think what's needed when we look at the challenges facing the economy, and let me just point out that 2007, both the Congressional Budget Office and the Fed estimated potential growth to be 2.6, and now the Fed is down to 1.8, and the CBO is at 2.0. Mm-hmm. That's a dramatic change. Right. So what policymakers need to do is think about the challenges and what are the true sources of the economic weakness, and address them with the correct policy tools, and not just rely, as it has recently, on the Federal Reserve.
Do you have a comment? I just wanted to make sure I got a comment on both sides. Dr. Johnson, do you have a comment on that?
Well, I think Ms. Love, you put the problem well, and I agree with Mr. Levy. Productivity growth is lower in these estimates, and that's not acceptable. I guess the good news for your side is you're in charge, right? You have all the branches of government, and you're going to make the policies. I'm skeptical that you're going to have the sorts of positive effects on growth that Mr. Levy thinks, but go ahead, do it, and we'll be measuring it carefully and be evaluating on that basis. I do think, though, you want to be very careful with financial stability, because it's been a big problem for our economy for a long time. You talked about the formation of the Federal Reserve, mm-hmm. and you should think really carefully about what you want Congress to be responsible for. I would not. Maybe you don't want the Fed to do it, fine. You need some responsible body with. But
there's a balance. There's a right. It's getting the right balance.
Absolutely correct. Yes.
Thank you.
Gentlelady's time has expired, and at this point, we would like to welcome Congressman Hill from Arizona, who is not a regular member of the committee, but I'm sure. Sorry, I believe I said Arizona, but Arkansas. But I would like to thank Mr. Hill. It was a conversation that he and I had that really sort of prompted us to put together the panel and this hearing. With that in mind, I would welcome you to the subcommittee and recognize you for 5 minutes.
I thank the chairman. I appreciate the opportunity to be a guest today for the hearing. Appreciate the panelists being here, and despite my affection for Mr. Schweikert, I'm completely delighted that I don't live in Arizona. I knew that would get your attention. I want to start out and ask about, we've had a lot of discussion. I appreciate Mr. Mulvaney bringing up this subject of non-treasury purchases, the limitations in Section 14 on open market operations. Would it be beneficial for the Congress to amend Section 14 and explicitly restrict the Fed from buying corporate securities? It's left open, and in this world of Chevron deference and lawyers in Washington, I have concerns that open market operations could be expanded just by clever lawyering at the Fed. Dr. Taylor, what is your view on that?
I think it would be a good idea to clarify. It seems to be an opinion that they would find it difficult to do now, but I think it would be better to clarify for the reasons you said.
Well, in her testimony, Chair Yellen dodged the question here, but then a week later, on September 29th, gave a speech to the Kansas City Fed where she said there could be benefits to the ability to buy either equities or corporate bonds that have to be weighed carefully. And she said, in her view, that the Fed does not have the authority to do that without Congress changing the law. But if you read a lot of legal precedent around the city, I think that could be argued. And so that gives me great concern that we would follow these other central banks. Dr. Plosser, you want to add to that comment?
I would agree. I think it would be beneficial. The Fed, by its nature and history, always prefers to have the option and the discretion to do what they think is the right thing at the right time. And those intentions are often good, but what discretion also does is allow you to do the wrong things at the wrong time. And so I agree with Dr. Taylor. I believe it would be useful to be more explicit about what the Fed can and can't do than leave it to discretion. I think the discussion of the Fed buying equities is a dangerous one. The other central banks around the world that do it for different reasons. There are institutional reasons. The ECB, for example, has to respond to 17 different governments. So if you confine them to only government securities, there's a whole big political debate on which country you prefer and which one you don't, and so it gets them out of a different set of institutional problems. So I think it would be beneficial. I agree.
And you've also, in your testimony, you talked about that during the crisis and the recession, the Fed purchased distressed securities under 13.3, and that such actions were a form of credit allocation, fiscal policy. Dodd-Frank partially addressed the issue of discretionary lending under 13.3, but you said you would go further. Could you talk about how you would go further?
Yeah, back in 2009, I first started talking about this, is that I think that 13.3, again, was a loophole, if you will, or it's a thing you can drive a truck through. And it is a form of fiscal policy. I don't think the Fed's role is to buy distressed securities and bail out individual organizations, and yet 13.3 allowed that. Congress did address that by restricting 13.3 to be broad-based programs that weren't targeted at any one company. But I think that, again, all of us know that there are ways to write an action that sort of really is targeted, even though it doesn't sound like it's targeted. My preference, though, is that we really do need what I've called a new accord about financial crises and about the role that the Fed plays in them, and particularly when it comes to purchasing private sector securities, whether it be equities or whether it be under 13.3. And that accord, from my mind, is to keep the Fed, and I alluded to this in my remarks, keep the Fed from engaging in discretionary fiscal policy actions, that there needs to be ex ante, that is, up front, an agreement about how such a circumstance would work. And I call that a new accord. And what that does is it would work something like the following. Suppose there really was a crisis, and we did have one. We had a crisis with AIG, and we had a crisis with Bear Stearns. And in those types of environment, things do happen, and you have to make tough decisions. So what I would recommend is that the Fed not be given the authority to buy those, particularly distressed securities in a crisis. That's not monetary policy. What should happen, in my view, is that there should be an agreement in advance that under those circumstances, under a crisis like that, it is the fiscal authorities, in this case would be the Treasury, let's say, make that decision and determine, perhaps in conjunction with the Fed's consultation, about what to do. And if that was decided it was appropriate from a fiscal and financial stability point of view, that the Fed certainly could be instructed by the Treasury to actually conduct an operation on very short notice. But, and here's the key, but those securities that were acquired during such an emergency would then be swapped by the Treasury for U.S. Treasury securities that would be given to the Fed in exchange for the private sector securities or distressed securities that were actually purchased. That way it becomes clear that that action has the responsibility of the fiscal authorities in making a fiscal decision, and the Fed would be given the treasuries in exchange, and they could go about conducting monetary policy as they saw fit.
Thank you,
The
Mr.
gentleman's time has expired. Let that go because of salient point. With that, I'd like to recognize the the ranking member of the committee, Ms. Moore, for 5 minutes. If it's okay with you all, we will be entering into a second round here.
Thank you for your generosity of your time, gentlemen. I wanted to ask this during the first round, but my time didn't allow it. Dr. Taylor, you, in your testimony on page 3, you talk about the importance of monetary normalization, and you talked about it in the context of the international community. You said that unconventional monetary policies with near zero policy rates have spread internationally. And so you say that if United States, if we normalize and have a rules-based approach, that this will spread as well. I have a couple of questions. Number one, do you think it would be a greater possibility of kind of gaming the system if people sort of knew that we had this rigid policy that wasn't flexible with changes? And what makes you think that we can, what evidence do you have that if we were to, given that we sort of poisoned the well with our monetary policy, should Europe and other central banks not have done what we did?
So I think there's lots of evidence that the unusual policies spread, and there's various reasons for that. The low interest rates, other central banks are worried about their exchange rate, and so they will tend to...
should they have done that?
Well, one of the questions is whether they overdid it or not. But if we had, in my view, a more normal, rules-based, predictable policy, the likelihood of that diminishes a lot. In a way, the United States is being more transparent about its policy, and that leads other countries to do the same. So that's what the research says. I talked to many of these heads of central banks about it. That's my sense. And it would be conducive to a more rules-based international monetary system if we had a more rules-based monetary policy. And so I think there's discussion about that. It's not clear how it would work, but that's what from my research and from talking to many people in central banks around the world, that's my sense of what
You have a comment on that, Dr. Johnson?
Well, again, if the FOMC decided to follow a rule of the kind being proposed, that's fine with me. I don't think Congress should be micromanaging. That's the bottom line. In terms, and the U.S. is clearly a thought leader among central banks, with whom I've also worked extensively. The Europeans have a very difficult set of problems. I don't think, and Dr. Plosser talked about, how that impacts what they can do and can't do in terms of monetary policy. I don't think that us going to a more rules-based approach would have a big impact there. Japan has got long, very, very deep structural issues. Dr. Levy's talked about those. Again, I don't see exact parallels. The British have trapped themselves in an extremely bizarre and difficult situation. Again, very, very, very different. So I think the discussion which we're having is a very good one about the U.S., what's good for the U.S. economy. I think the impact on the rest of the world would be pretty second or third order.
I agree. Dr. Taylor, I want to ask you another question. You have been a critic of intervening in markets. So I'm curious as to what your thoughts are about President-elect Trump's intervention in Carrier and now threatening Boeing. Do you think that is, what would your advice to President-elect Trump be?
Well, I don't know the details of either of those cases. What I would say is that with respect to making the U.S. an attractive place to invest and stay here, that's key. And to me, there's opportunities for that, and that is regulatory reform and tax reform. We talked a few minutes ago where monetary policy would play. I think there is a sense in which if the Fed is viewed as an organization which will take care of all our problems, interventionist perhaps, then that reduces the chance for these reforms like the regulatory reform and the tax reform. So I'm quite optimistic now that especially if you get some monetary reform, we'll move in that direction. And that's really what I would argue we should do in these cases.
Versus interfering in that way. You have a thought on that, Dr. Johnson?
Well, if we apply Dr. Levy's sensible principles, that generating uncertainty and making people confused about what's going to happen is a problem, then you should not absolutely not use presidential authority to mess around with individual companies.
And so, Dr. Taylor, I do want you to be on the record saying that you don't think we should do that.
Say what we should do is make this country an attractive place to invest. That's what we should do. How you do that is a question. I think it's regulatory reform. I think it's tax reform. I think there's a lot of reforms. And you mentioned education. There's a lot of things in education to do. All those things make our country a more attractive place to invest, more attractive place for job creation, and for higher incomes and productivity. I think it's pretty straightforward. Hard to do, but that's what we should do.
Thank you.
Gentlelady's time has expired. So at this point, I will recognize myself for 5 minutes, and if I have time left, I want to come back to Dr. Johnson's discussion of the Fed rule. Dr. Levy, I want to start with you and also hit Dr. Taylor. Your statement notes that, quote, "The Fed's fully discretionary approach to conducting policy, highlighted by its ever-changing explanations for delaying rate increases, adds confusion and has created a very unhealthy relationship with the financial markets," end quote. In light of your statement, Dr. Levy, can you please share your opinion about whether the Fed could do a better job by referencing a more principled policy strategy and providing a more accessible explanation of how the FOMC decisions depend on data, rather telling us in plain English what data matter and why and how they matter, and would measures like these help safeguard monetary policy independence and help goods and services, which obviously includes labor as well, find their most productive employment?
The Fed has created an extremely unhealthy relationship with financial markets. It not only bases its actions, but also bases what it says on how it thinks the market's going to respond. And the markets respond and think about what the Fed's going to say. And when you get to the point about data dependence, you come in and you see another Fed member gave a speech on something and they said they're data dependent. You say, what's that? And the honest answer is, it's anything they want it to mean. And that's not the right way to conduct policy. So I think what the Fed should do is move toward a flexible, rules-based monetary policy framework, and in particular, de-emphasize short-term financial fluctuations and economic fluctuations. That comes with the territory. Stay away from that and move and look to the long run and base policies on the long run and absolutely change its communications and its official policy statements toward achieving its long-run objectives and away from day-to-day fluctuations in the markets that it can't do anything about and has no impact on the economy at all.
Dr. Taylor, you care to comment on that?
Basically, I agree. I couldn't put it any better than what he says. Flexible, rules-based. I think rules-based should be flexible, just to be clarified.
Well, I do too, which was maybe we weren't as clear in the Form Act as we would have liked, but I at one point in the hearing dubbed it the Yellen rule. They can set whatever guideline that they would like. It's just having some sort of guidepost to reflect upon, and I guess that's Dr. Johnson, your quote that I wrote down here roughly is, I guess it wouldn't be a quote, roughly I wrote down, if the Fed grants if the Fed cares to adopt a rule, fine, but Congress should not mandate a rigid rule. And I don't think I would disagree with that. I don't think the rest of the panel would disagree with that, but just want to give you a moment to address that if you would like to. And then I do want to very quickly in my remaining time, Dr. Levy had answered this, but I'd like to hear about the politicization of the Fed, and he's addressed that a couple of times, so go ahead.
So I like what Dr. Plosser is saying on this issue, and he's been a member of the FOMC, and I haven't. Flexible rules base is a little bit of an oxymoron, but not really. And the Fed has actually improved its communication and transparency a lot since, for example, 1990. They did it in the second half of the 1990s. Ben Bernanke did a lot when he was also chairman. I think it's really hard to legislate that, Mr. Chairman, and I worry that it goes, with all the best intentions, it will become micromanagement and too much control. I think you want to have this kind of discussion. This is very helpful. Put good people on the board of the Fed and the FOMC, and let them figure out how to improve communication and transparency, which is what my colleagues have been arguing for a long time.
Will they do that without a legislative nudge? That's the question that I have, and I haven't been convinced of that. But
I think I think that the Republican administration and Congress will appoint most of the members of the Board of Governors, and we'll see what happens to the FOMC over the next number of years. So I expect you will move in this direction.
As we've learned, elections are not predictable, and there are changes. And I want to make sure that what is belt and suspenders in one administration is belt and suspenders in another. And that's really the purpose. So, Dr. Taylor, real quickly, and Dr. Plosser, you haven't had a chance to address sort of the politicization of the Fed.
No, I think the idea that the Fed sets its strategy, its rule, that's its job. It communicates what it is explicitly. If it deviates from it, it says why. Those are done through hearings. It creates a much better process. And, you know, individuals can make a difference, but this is beyond individuals. We had over 100 years of experience, and there would be a great value in terms of how the Fed operates with its staff, with its researchers and the decision makers, and how it discusses not just to you, but the American people generally about what it's doing. It would be far better to have a description of what it does. And I don't think it's as hard as people think it will be.
Yeah, my time has expired. With that, I recognize the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chairman. This is for any of you. It seems as though most, if not all of you, have argued against using unconventional monetary policy in the future, presumably to rely more on the traditional means, the overnight lending rate or whatever. And I'm wondering if you believe as well that that implies that the Fed ought to have a higher inflation target. And the reason that I ask that is that the Fed's current inflation target is about 3%. And yet, in fact, in past recessions, and we should all acknowledge that God has not outlawed the business cycle, we're going to have another recession at some point, the Fed has typically cut by more than 4%. So do you believe we should have a higher inflation target so that the Fed has a bigger buffer so that they can avoid using QE, which you seem to say is a bad thing to do? Anybody?
Well, I don't think the Fed should raise the inflation target. There's something there to be said for keeping it. One thing, it would probably prolong these unusual policies, but it's fine. Sometimes since this was instituted, it's sometimes taken as a reason to gun things just because the inflation rate is 1.7 rather than 2. So that should be looked at to some extent. These are inflation rates that are measured with some error, but I see no reason to be raising the inflation rate target.
So what leads you to conclude that they won't need the same latitude for reduction in interest rates that they have typically utilized to combat the recession?
So one of the rationales for that people make for raising the inflation rate is that for some reason the equilibrium, real interest rate, has changed, has declined, and so there's less room for policy to move it down. I think that's quite questionable. I know there's a lot of people who think that. If you look at the Fed's forecasts, they've ratcheted that down by a percentage point over the last 3 years. When I look at the U.S. and the world, I don't see evidence for that. And in fact, I think to some extent, the backup on long-term rates over the last month or so is some evidence that there's not just simply a low equilibrium interest rate as the Fed describes it. So I don't think there's reasons for that. And also, we've had much experience about how to manage monetary policy at this 2% inflation target. Is also an international aspect. Most other countries are in that same region. And so that with respect to stability of the overall exchange rate system, it's of value to have a common inflation target. If anything, maybe in the future, when we get better measures, it should be lower. But I think it's fine right now.
Dr. Johnson?
Mr. Heck, I agree we shouldn't lower the inflation target. I think it's 2%, roughly speaking. But yeah, I think you're hitting a really important nail on the head. And this goes to what Mr. Huizinga was saying, which is about, what should Congress decide and what should be in legislation. So if monetary policy is going to run out of bullets, or conventional monetary policy is going to hit this zero interest bound on a regular basis, which is what you're saying, and I agree. And if we agree that unconventional monetary policy is only appealing in very, very specific circumstances and probably isn't much use over a regular business cycle, then what should we be doing when the economy turns down by that much? Well, I think thinking about the so Dr. Plosser is calling for a new accord. I think a new accord broadly constructed would include Congress thinking about the use of fiscal policy for countercyclical purposes. And I would remind you, Mr. Chairman, that in early 2008, President George W. Bush proposed, and there was a lot of Republican support for, and Congress passed a tax cut for countercyclical purposes, early 2008, right? So before Bear Stearns. That was a good idea. Well done. That was a good idea. Use of countercyclical fiscal policy in a relatively moderate way. Yeah, in retrospect, perhaps too small, but it was a good idea. I mean, we've somehow developed, or you've developed, this aversion to any countercyclical use of fiscal policy. I don't think that's a good idea. I think that there's a measured use for it, and that's where Mr. Heck is going with his question. Don't rely on the central bank to save the day, because they will not be able to necessarily next time.
So my favorite personal characteristic is humility. I don't have much time left, but I'm wondering if any of you would be willing to put yours on display by acknowledging that you argued in advance of the use of quantitative easing, or during it, that it would lead to inflation, which we have not yet experienced. And if so, if you're willing to admit it, if you would also tell me why you were wrong. Dr. Levy, are you admitting you were wrong, sir?
Yes. And so typically when you move to QE and there's tremendous liquidity and you leave rates too low, too long, it generates excess demand in the economy. And that has not happened. Where I was wrong is the Fed's excessive ease did not translate into excessive bank lending and acceleration of nominal GDP relative to productive capacity that would have boosted wages and inflation. Having said that, beginning with QE3 in summer of 2012, it just was clear to me, even if inflation didn't rise, that the distortions created by the Fed's QE and forward guidance were going to be very costly, and I think we're going to bear out those costs. Back to your earlier point on the flexibility of monetary policy, should there be a recession. I don't think...
Should there be? Sir, don't you mean when there is?
There will be. I don't think you would be having those same concerns now if over the last couple of years, as the economy's grown along its potential path, that the Fed would have normalized rates. And so as Dr. Taylor said, if the Fed had normalized, history suggests it would have had no negative impact on the economy, and real interest rates would be higher, and the Fed would be having that much more flexibility than it is now perceived to have from the vantage point of where rates are now.
I would acknowledge hindsight is a wonderful thing in this regard, in all regards, including our forecast about the net impact of quantitative easing.
Gentleman's time has expired. Would love to hear how regulation might have hampered that excess lending with that equation. But I do need to move on to Mr. Schweikert from Arizona, who is recognized for 5 minutes.
Thank you, Mr. Chairman. You know, it's a complex ecosystem, but let's stay a little bit on this theme. Mr. Chairman, thank you for tolerating sometimes my questions get a little off track, but I'm trying to sort of understand some things. If I was sitting in your lecture halls 10 years ago, and during that lecture, the discussion was we are going to substantially, dramatically increase monetary supply, liquidity in the United States, but all over the world. What would you have put up on the board as saying, and this is our prediction of what will happen to productivity gains because of new equipment, and why has not, what I would have assumed had been obvious, why hasn't it happened? What has happened if we had this discussion 10 years ago, what did we get right in our predictions and what have we gotten wrong? And what is the solution to productivity? Is it purely on the fiscal side and monetary should not even put it into its calculus? Anyone willing to play on this subject?
So let me offer at least one reaction, and that is, the first thing to recognize is that monetary policy is not a solution to any form of productivity problem.
Okay, and sorry, you actually beat me to my punchline, but I was going to wait till the 5-minute mark for that.
Can you pull your mic a little closer?
Yeah.
Closer.
And I think it's a mistake for the public or Congress or anyone else to believe that putting that in the hands of the central bank is the right thing to do. Now, economists really don't understand a whole lot about the evolution of productivity. It is not something that we know much about. We don't predict it very well. We know some of its determinants. But at the end of the day, the long-run health of the economy and our ability to gradually, continually increase our standards of living is all about productivity. But nothing else really matters very much at the end of the day.
And look, this one should be nonpartisan, but there's something wrong in the formulas we all went to school under of if I put this much money in education, if I put this much money in tools and equipment, if I put this much money in lending capital for businesses, plant and equipment, you'll get this type of productivity gain. And now we're living in a world for several years now where lots of liquidity, lots of money have actually gone into those, and I'm not seeing it. So what did we get wrong?
Putting money through a central bank doesn't solve the problem. The productivity is generated by how that money gets used at the end of the day.
Okay, so is the formula in the amount of liquidity that central bank expansionary policy that cash ended up on money center banks' books, buying?
I'm sorry. So this goes back to the previous question about why we haven't had inflation. I think what many economists, myself included, were wrong about, in part, had to do with a lot of the money, I'll call it money, but that's not really what it is. A lot of the reserves that were created through quantitative easing are still in the banking system.
Okay.
As Dr. Levy said, they haven't been spread out into the economy, which would actually turn them into money and then turn them into inflation.
So if I were even to look at banking sectors and a couple other sectors and take a look at what we would all around here refer to sort of as Tier 1 or Basel compliant capital, a lot of that you might have, if you could do the formula backwards, may have come from the quantitative easing?
Right. So I think quantitative easing and low interest rates did two things that were not terribly helpful. One is they led to what I would describe as a lot of financial reengineering. Companies buying back debt, or buying back stocks, or taking a form of leverage. It didn't get used in the usual form of lending and productive capacity.
Solicitation of the entire panel. So if I came to you and said, all right, productivity gain is important for my friends on the left, for particularly those on the right, whether we're going to be able to afford our social contracts, all the other bells and whistles that society wants, but it's going to come from fiscal policy or from types of fiscal policy where we create barriers for growth and we need to stop doing it, more rational, everything from tax system, regulatory system, and the interplay between those, and we have to stop thinking somehow the Federal Reserve is going to bail out our failure to act. Am I speaking heresy, or do we sort of from all sides, do we agree that's fair?
So just quick, so we teach, I think all of us, that productivity growth comes from investment and from technology. You know, there's a famous formula that tells us that. And right now, if you look at our low productivity growth, it's, you know, less than 0.5% over the last 5 years. We also see very low capital accumulation. And we also see very low, what's called total factor productivity.
Okay.
So those are the reasons. And how do you get more private investment? I think it's this regulatory reform. It's the tax reform.
Okay, if the chairman will allow me, but I want to hear Dr.
Very quickly.
So, as I pointed out, the Fed has very successfully lowered bond yields and the real cost of capital. Why hasn't that stimulated more capital spending? That's been the weak link in the economic expansion and contributing to productivity. Why haven't businesses responded to the lower cost of capital? And surveys suggest businesses' biggest concern is taxes, regulations, and the like. And once again, I think it gets to the point where we need to address those concerns with the right policy tools rather than more monetary ease, which the Fed's model tells it should do.
Mr. Chairman, thank you for your patience. I guess the theme I was working on is in many ways we can build a model that demonstrates that there is a massive, massive misallocation of capital, and it was arrogant of us to somehow think it was going to go where we all wanted it to go, and that at some point those of us who do fiscal policy need to do the hard things. We need to do the tax reform. We need to do the regulatory reform. And some of this, I believe technology, whether it be the supercomputer we carry in our pocket, we can have a revolution in how we regulate in a dramatically more effective, less expensive, rational model. And I'm terrified I don't hear enough discussion about it. So with that, I yield back.
The gentleman's time has expired. With that, the chair will recognize Mrs. Love of Utah for 5 minutes.
Thank you. What I failed to mention in my Tylenol analogy is that, you know, when you give your child way too much, you end up hurting parts of the body that had nothing to do with the fever to begin with. So I would actually say, in other words, that when the Federal Reserve ventures out of monetary policy and they expand into regulatory policies and practices, they actually hurt parts of the financial world that had nothing to do with financial crisis, which is some of the examples that we've seen. I actually wanted to go and expand upon what I was talking about earlier in the Federal Reserve Act and the amended Humphrey-Hawkins to include full employment. What, in your opinion, have we gained from that amendment? I haven't spoken to you, I haven't asked your opinion, Dr. Plosser, if you wouldn't mind.
I'm not sure we've gained a whole lot. I think there's no other central bank in the world that has a mandate like that. Many of them have inflation targeting mandates. Many of them have hierarchical mandates where it puts inflation first and then says, well, if inflation's okay, you can sort of do some other things to help the economy. I think what we've done, unfortunately, is open the door for asking the Fed or expecting the Fed to do all sorts of things that it's not particularly suitable to do. And my comments, remarks I made, and they seem to sort of want to take responsibility for everything from real wage growth to participation rates to how many part-time workers we have, to, all sorts of things that monetary policy just really can't do. And so the whole thrust of my argument is that by narrowing the things we ask them to do, the easier it is to hold them accountable for whether they are successful or not.
And I would think that the easier it is,
the care has to be that you don't ask them to do things they can't do.
Yeah, and it would also be easier for us to not have to look at every single aspect and micromanage everything that they do also.
Exactly.
Do you have a comment with that, Dr. Johnson?
Congresswoman, I guess the
In
question...
terms of what we've gained,
Sure.
in your opinion, what we've gained from that.
Sure. Look, I think the legitimacy of our government institutions is really important. For whom does the Fed work? And how do you communicate that? I think we mustn't lose track of that. It's taken a beating, partly through their own, inattention to financial regulatory issues pre-crisis, pre-2007, 2008. And, I think if you remove the employment mandate, it would be misunderstood. That would be, I agree that other central banks formulate this somewhat differently, but I think it would be misunderstood by the American people. And that would not be my recommendation, but, that's your business. What is the problem you're trying to fix? On Monday, I was with Chairman Volcker at an event organized by the Volcker Alliance, and I was reminded by his leadership and his ability with his colleagues to bring down inflation. It was a very bad problem when he came in. And Chairman Volcker, with others at the Federal Reserve, really put this country on the path to what was then an impressive economic recovery. And I don't think there was anything in his ability to do that job, which was an incredibly hard job with a lot of political pressure. I don't think the Humphrey Hawkins Amendment made it harder for him to do that job. So I think the problem is actually what you said, what's the nature of our financial system, how unstable is it, and what are we going to do about that? That's a good question. Should the Fed be on the job for that? Mr. Volcker actually has some other ideas. You might want to look at those. I really recommend the work done by the Volcker Alliance. That's a really good question, the financial stability part. The Humphrey Hawkins part, I really would not recommend that you repeal that, but again, you're in charge, and if you want to do that...
I just asked what we gained from it, and I haven't heard any real...
Legitimacy
on what we've actually gained from that. I mean, we can sit there and say, hey, well, I wouldn't remove it for fear that something may happen, but I haven't heard any example of what we've actually gained from that, from that amended to include full employment. Anyway, I just have one more, well, I don't know if I have enough time to ask one more question. But some of you mentioned that the Fed continued to expand its role in systemic regulation and credit allocation. In your opinion, Dr. Levy, very quickly, do you think that should make us worried about its ability to produce sound monetary policy?
Yes, in general, because this is just by getting into credit allocation and expanding its scope, it's just moved monetary policy beyond where it's become capable, and it only generates, distortions in economic and financial behavior.
Thank you. Great panel today. Thank you. Thank you.
And certainly, last but certainly not least, we have Mr. Hill of Arkansas, who will be recognized for 5 minutes.
Thanks, the Chairman. Thanks again to the panel. Good discussion about the fact that we have $4 trillion on the Fed's balance sheet, up from $800 or $900 billion before the crisis, and yet we don't seem to show much for it. As I've said to Chair Yellen before, with deficit spending, with $4 trillion Fed balance sheet, shouldn't we be in some sort of Keynesian nirvana of economic activity, which we're obviously not. And in my view, the fundamental issue is here, not since the 1930s have we seen a money multiplier rate at 4 at this low level. And I think it speaks to, Eccles in the 30s called it pushing on a string, and everybody understands that. But it hasn't been lower since, say, 1935 than it is today, period, full stop. And so, Dr. Levy, I loved your testimony, and it seems to me that the reason is non-monetary policy structural impediments, which we never get an answer to when the administration comes and testifies. Secretary Lew, 0. Chair Yellen, 0 on this topic. They will not admit explicitly that there are major non-monetary policy structural impediments, such as the fact that operational and credit risk has been completely mangled by Dodd-Frank, that there's just plain fear on the part of market participants, whether they're small business people trying to comply with Department of Labor new rules, or implementing the Affordable Care Act, or maintaining limits on their employee to comply with avoiding the Affordable Care Act, that their staff, in my judgment, is misdirected from productive functions to compliance-oriented functions. And finally, that Dodd-Frank, I think, has made all the institutions sort of aligned in a pro-cyclical sort of way, and instead of allowing diversity in risk parameters among the activities of our banking institutions. So what in your view, and be specific, would get our multiplier up? It took 30 years or more for the multiplier to rebound from the 1930 depression, a long time. But it fell off a cliff from 8 or 9 in 2007, straight to the bottom. It's never moved since we started all this stimulus. So, Dr. Johnson, what in your view, what's the single biggest thing we can do in the government to stimulate a faster expansion of the multiplier?
Great question, Mr. Hill. You know, and I don't disagree with the formulation, although it's not exactly the standard economic version. I think we'd focus on the productivity growth, and the money multiplier and monetary policy will adapt to be consistent with that. Look, I'm a skeptic with regard to the regulatory impediments, but you know.
Why? Give me one reason why.
Because I've spent a long time studying that question and that issue and those measures around the world, and I don't see
So you believe that banks are lending more and have higher productivity and credit is getting to consumer and businesses better today than it was in 2005?
No, sir. Can I finish answering the question?
Of course.
Look, we had a huge financial crisis, Mr. Hill, and I think if we're looking at medium-term, longer-term growth, the most important thing is avoid having another crisis like that, right? So that was the goal of Dodd-Frank. You don't like it. I understand that. You're going to repeal and replace it. I understand that. Let's see what happens. I'm very worried. I'm very worried about that. But on the regulatory pieces, it's going to be fascinating. I'm just watching this from the side, and I wish you well, and because I want good things for the American economy. But I think the story that you had, that narrative that you're going to remove those regulatory impediments, and very good things will happen because the impediments were the problem. I'm skeptical. I'm not disagreeing with it.
I'll put you down as, excuse me, it's my time. I'll put you down as a doubter on regulatory. How about tax reform?
I have testified to this Congress a number of occasions in favor of various forms of tax reform, and I think if you can find ways to simplify the corporate tax code, remove a lot of the special treatments and so on, that could be extremely helpful. I'm in favor of lowering taxes, absolutely, on the lowest paid Americans. I don't see why anybody earning under $50,000 a year pays any tax, and I'm including Social Security contribution. So yeah, I'm all in favor of that, but be careful with those projections, the dynamic scoring that says it won't impact the budget deficit, because it will. And I think you want to be very cognizant of the impact on the budget deficit, which I know you talk about a lot, and so please really take that seriously, because otherwise the debt numbers next time we come back here are going to be a lot higher.
10 seconds. Somebody else want to tackle that? Dr. Levy?
Yes. Okay. I think if you were to get rid of a lot of the micro regulations in Dodd-Frank, banks are sitting on trillions in excess reserves. It would increase banks' willingness to lend, and you'd see the biggest increases among small and medium-sized banks, and a lot of their lending is to medium and small-sized businesses that generate a lot of jobs. Okay, but that's on the financial side. On the non-financial side, tax reform, and I emphasize reform and not just increased deficit spending. Corporate tax reform that lifts the gray cloud off of corporations, simplification, individual income tax cuts, but don't go overboard. And the third point is normalize interest rates. You raise interest rates, that reduces the demand for money, that increases velocity. So what I'm really talking about here is resetting monetary policy, but also resetting fiscal and regulatory policies in a way that I think what's happened over the last, I don't know how many years, these inhibitions to growth have constrained both aggregate supply and aggregate demand. Let's reduce those inhibitions through wise policies, both within the financial system so that banks are putting to work the excess reserves, and in the non-financial system so that businesses, and once again, if you look at economic performance so far this expansion, consumption has grown at a fine pace. So is housing. The weakness is capital spending, as Dr. Taylor said. The capital stock net of depreciation has been declining. This means not just lower capital ratios relative to labor, but there's less training of labor of new capital. You really need this kind of regime change, and then you're going to get the multipliers moving back up. Maybe the reason why monetary policy has worked is because it hasn't worked. I'd love to see the regime changes that really force monetary policy to normalize.
I think therein lies our, we have done one thing here. We've successfully bended time for the last 10 seconds. So I do deeply appreciate the time invested by our panel and by our members on this very important issue, and look forward to continuing the conversation. So with that, without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able to. And without objection, all members will have 5 legislative days with which to submit extraneous materials to the chair for inclusion in the record. And with that, the hearing is adjourned.